Good evening, ladies and gentlemen. I think we might start. For those of you that haven't met me, I'd like to introduce myself. I'm Darren Katz, and I head up the sales and client service team at Clime. I'd like to take this opportunity before I call John up onto stage just to welcome our DSP, our discrete share portfolio, and our Australian Value Fund clients, as well as our MyClime members and our Clime Super clients as well. As is customary, we don't take too long. We get John up here pretty quickly. So, John, I'd like to invite you up just to give us your views on the global economy, our key themes for the rest of 2012, and how that impacts the Australian investors in the room. Thank you.
Thanks for that, and thanks for coming tonight. I know most of you have read the disclaimer, so I have to go through this process. It's just general advice. I know some of you, I don't know all of you, and I'm just going to talk about things tonight, and you can take it or read it or listen to it or follow it. But it's all done with passion and thought process, so at least you know it's coming from a good heart. Whether it turns out to be true or not, we can find out later. Just a quick one for the clients of ours. We've got a change coming in July, which I just want to alert you to. We're changing our administrator and custodian. Hopefully sometime in July, so we're moving from perpetual. The benefit of that is lower fees, improved reporting and better returns on cash balances, which I know is all close to your heart. So we've been trialling the system internally for the last 6 months, and it looks pretty good to us. We think it's an enhanced service at a good price. So when you do get the phone call or the letter in the mail, that's what it's about, but we can talk about it later outside if anyone's interested, but it is good news. Okay, so I'm going to do my usual trick and go around the world tonight. A bit more focus on the US. I think if you're like me, you're a bit jaundiced by talking about Europe. I'll have a couple of slides on Europe, so don't be disappointed, but I think there is a bit of good news around. And to get to that good news, I think we better ask some questions, and the questions are on the board. First question is the world economy in a worse position than it was after the Second World War? So I've got some charts there. It's very hard to put the current situation into context. And there's a lot of talk about depressions, recessions, and we've never been here before, and what's it going to look like. So we'll just investigate whether America and Europe have been in worse shape at a previous point in history, and did they get out of it? Is the US economy recovering better than we are led to believe? You know, we have a lot of constant commentary on the American recovery. Talk about another recession. Is the growth slow? Is the growth real? We'll look at some charts tonight, and hopefully we'll draw some positive conclusions. Is Japan an example of what the US and Europe will look like if they don't deal with their debt situation? And that's an interesting question, because Japan's been in stagflation mode for now 30 years. Okay. Is China's slow growth really an issue for Australia, and do we actually understand what slower growth means? You know, we hear this constant chatter about hard landings. You know, what is a hard landing? Does anyone actually know? But we hear these slogans constantly, and if we don't understand what it means, or if we don't understand it could be an overstatement of reality, then we might get frustrated. Have we in Australia used excessive debt to create a standard of living that had not been earned? And that's an interesting question. Were we living beyond our means, and we're now just in the after party? And we'll look at some charts to investigate that. Is Europe heading for a fiscal and banking union, but its current creation is being stymied by financial institutions? And this will be a recurrent theme tonight, talking about the financial institutions of the world. And is what's happening in terms of the workout actually to their benefit or to their detriment? And if it's to their detriment, are they hoodwinking us to think that change is not going to be good? Is it possible that the solutions and the recovery is not to the benefit of the major banks of the world? Okay, and let's not forget that the banks of the world, the major ones, took us into the mess we're in now. So if they were part of the cause, they're certainly going to be part of the answer. Okay, let's just recap on some things we all know about. The growth outlook is all about emerging economies. It has been for the past decade, and it will be for coming decades. So the developing countries of the world, China, India, Brazil, parts of the Middle East, Russia, South America, parts of Africa, that is the growth engine of the world, growing around 6 or 8%. The developed world, Europe and America, Japan is growing at 0 to 2%. As I always say, you add one to the other and halve it by 2 and you get the world growth of about 4%. I also say that I don't get paid enough to come up with that answer, but a lot of other people do, and they come up with the same answer. So that's just lucky. Regarding mobile phones, we're not going to talk about mobile phones tonight. Good time to turn them off. I do know that the futures market is trading, and people are very interested in what I'm going to say, and they're going to take positions. So prefer if you don't do that during the... Okay. The emergence of China won't stop, and here's another theme which we'll investigate. Now here's the chart of GDP growth over the last 10 or 12 years. No, China didn't start at $1, but we just put it there to emphasise. It started about $1 trillion a dozen or so years ago, and it's now a $6 trillion economy. It's been massive compounding growth, and it's gone right past France, Japan, Germany. Not quite anywhere near USA, but we always ask that question, how much longer will it be before they catch USA? Our best guess is about 20 years. But you can see the dynamic growth. And I'll show you a table later which goes into the GDP per capita, and our statement is clear that that growth will not stop anytime soon. Okay? 46% of the world is really in 4 countries. The big ones are now USA and China. The other 2 significant economies are Japan and Germany. Now, 46% of the world is in those economies, and we might think things are bad, we might think we're in recession, but none of those 4 countries are actually in recession. The USA is growing at about 2%, China 6 to 8, Japan 1 to 2, Germany around 2.5%. So they are not going backwards, those economies, and they're the major ones of the world. So it's a bit hard to draw a statement and say the world's in recession. When you scan across the next 16 countries, the minority of those, a very small minority, are actually in negative growth. And the negative growth areas are Italy, Spain, and that's about it, maybe Turkey. And South Korea is having a bit of a tough time. So the majority of the rest of the major economies are growing 2 to 3%. So it's very hard when you scan across the major economies of the world as a whole to draw a conclusion that the world's going backwards, because it's not. We read about all this, but the world is still growing. The pressure points are in very small economies in terms of a world context. Now, one of the reasons why the world is growing is because of the activities of central banks. Central banks are being very, very supportive of markets and credit markets and the world economy through quantitative easing, forms of currency printing. And you can see this in the explosion of balance sheets of central banks of Japan, Europe and America. However, despite their ability to generate or print currency, they are not the biggest banks in the world. The biggest central bank of the world is the Chinese central bank. And I think a lot of us forget that. And that's going to be more and more significant as we go forward, because it's going to be the activities of the Central Bank of China which is going to be of more interest to us in Australia than the activities of the other 3 central banks. And the beauty of the Central Bank of China is it's a real bank. It didn't print money to become the biggest. It actually traded through its economy to make money, to make trade profits. And that's its reserves. Its reserves are real. And the question is, how are they going to recycle those reserves in coming years? What are they going to do to ensure that their economy grows? The other central banks are printing money to ensure their economies grow. It's quite different. The effect of quantitative easing is quite profound on bond markets. And right where we sit today, there's a discussion point about bond yields. Are the bond yields predicting Armageddon, a massive recession, the likes of what we haven't seen for 70 years, and we've been talking about this now for 5 years, so it hasn't hit us yet? Or is it a result of quantitative easing printing money? Now, I'd say right now 75% of commentators have swung to the recession argument. They're saying that the bond market is a result of the markets predicting recession. And so very low returns are being offered, so let's take a very, very low return from the bond market. That's possible. There is the other argument by some more lateral thinkers in this room, that the printing of money and the creation of liquidity in the world has created a bubble in the bond market. So there's too much money invested in investable assets. There's not many growth assets around at present, and a lot of the liquidity is being withdrawn into the bond market. And to support that, you can see some quite crazy yields, because some of the countries which are growing actually have low yields. and countries which aren't growing have low yields. So there's no consistent comparison between economic growth and yield. It's just a schmozzle. And when you get a schmozzle, I think it's caused by liquidity, not caused by a rational investment process. Just my view. The most starkest example of that, and there's that phone again, but I mean, I remember a year ago, because I always remember my good predictions, because there's so few of them, I remember. And last year, I was getting on a plane after this presentation, if you can recall, and I had a chart like this, and I quoted that the Italian bond, I scratched my head and I couldn't work out why the Italian bond yielded less than the Australian bond. And I had this flash and said, there's a trade for you, go and short Italian bonds and go long Aussie bonds. And did nothing about it, got on a plane and off I went. And here we are a year later, and what the yields were 4.5% on an Italian bond and 4% on an Australian bond, 4.25. Australian bond today about 3, Italian bond about 6.25. So that was an amazing trade I made up on the night. So to do it again, I think the starkest bond on that table is United Kingdom. It's very hard to understand how United Kingdom bonds can be trading at 1.5%. That's well below its inflation rate. The fiscal account of United Kingdom is about 8% negative. They have a trade deficit. Their currency's depreciated by 30%. They've run out of money a couple of times in the last 6 months. They're in rolling recessions and they're printing money. Now, how, knowing all that and being sensible, would you buy a bond in UK ahead of the Australian bond? And not only do it slightly, but do it by over 1.5% in yield. Okay, so if there's any trade tonight, that could be it. Short UK bonds, go long Aussie bonds. But buyer beware, I have no idea what I'm talking about, I'm just looking at a chart. Okay. But it's interesting that Australia has just joined that peer group, and my question is, why did it take us so long to get in there? We've only just come in there in the last 2 months. Up to then, we weren't invited, even though we had the world's best treasurer and the world's best balance sheet. Bond yields below equity yields, what does it mean? This is the same question. This is the American history of the yield on equity market and yield on bonds. 3 times has there been crossovers in the last 80 years. The first time was a interesting crossover. It went there for a moment and then we had a depression. In the middle 50s it went there and it stayed there for quite a while. Okay, so bond yields went for a period below, bond yields were below equity yields for quite a while, then they crossed over and went above, and that was in the mid-50s. And then we've had another touching point where bond yields have come back and touched the equity yield again in 2012. Okay, so they've sort of crossed over, bounced off, and done different things. Now the crossover in 1930 was preceding a depression. The crossover of the middle 1950s was during a high growth period, which was sustained. Now the bond yields went on in another way, flying up, ultimately crashing in terms of going up in yield and bond prices crashing with the oil crisis of the 70s. And now we've had a massive rally in bond yields and they've gone below equity yields for the first time in a long time, 60 years. And the question is that forecasting recession, or is it back to my comment about we've got a liquidity trap in bonds? And is it also forcing us to now view equities as an opportunity because the yield on them is so compelling and the opportunity cost is so low that we should be looking at growth assets again? Okay, let's just look at the bond yields, low growth and the risk of inflation. Bond yields in the US, Germany, Japan and UK and Australia are now below inflation. So they're actually offering negative real yields. We haven't seen that in a long time. Okay? So there's no inflation compensation in owning bonds. The focus of investors, and I mainly put investors in this category as the banks and the big institutions, their focus is on the return of their capital, not return on their capital. They are fighting for survival, the major banks of the world. Now that might sound a bit scary, but I think it's quite clear that the banks of Europe today, if they mark their balance sheets to market, are all insolvent. If you say it quickly, you don't get worried about it. But, you know, clearly the Spanish banks are insolvent. We'll talk a bit about that shortly, about where this $100 billion is going. But when banks are facing insolvency and they've got real pressure in their asset bases, they do strange things. Now, the banks don't want to lend to the open market. They want to lend to governments on the assumption they'll get their money back. And this is causing complete mispricing of government debt. And I'll show you my old chart about European bonds shortly. Low negative yields on capital and savings will detrimentally affect retirees. So if you give your money to managers who are parking money in low-yielding assets, a la bonds, and you think about the broader community of Australia who don't have a choice in self-managed, who are just giving their money to fund managers and institutions who are parking 30 or 40% in bonds and taking 1%, 2% and 3% yields, and they've got great supporters. There's been a lot of government experts saying that's a good idea recently. That could potentially be a disaster long term, especially when you think that's 2% and 3% pre-tax, and they're missing out on franking credits. So it's going to put real pressure on retirees who want to grow their capital to retire. Okay? You might maintain your capital, but you run the risk that you won't make enough money on that capital to have a sufficient retirement. The other risk you run is that we get a surge in inflation. Now, I'm not predicting inflation tonight. That's for another night. It's not tonight. I think I've talked about the risk of inflation. It's nowhere on the horizon right now. I'll show you some charts why shortly in America. But we have to be conscious that in previous history, quantitative easing has led to inflation. Now, it hasn't happened this time because everyone's doing it and it's offsetting. The big trigger point will be when China decouples from the US dollar. And that's possible in the next 5 years. And when they do, China will stop exporting deflation or start exporting inflation. Now, that possibility is not priced into the bond markets at present. So that's the risk you have when you buy bonds, apart from other risks regarding sovereign solvency. Now, we're going to have a good look at the US tonight, only because it's more interesting in Europe. I'm sick to death of Europe. We're going to really focus on US tonight and just look at what people are saying about it and what's real. So we'll look at some real charts. It's interesting to compare the US and the world in 2009 to the US and the world today. Just some quick comparisons. We've got oil from 3 years ago doubling. We've got the S&P market cap, so this is the value of the major the American stocks, has doubled in the last 3 years. The earnings per share has doubled over the last 3 years of American corporations. American corporations' profit margins have nearly doubled in the last 3 years. Gold has gone for an almighty run, but that's probably because of quantitative easing and the devaluation of the US dollar. The balance sheet of the Federal Reserve, the Central Bank of America, has increased by 40%, but it's in the last 12 months that increasing rate has slowed down dramatically. The massive growth in the Federal Reserve was in 2008, 2009, so it's slowed down. Government debt's gone up by 50%, so that's a bit of a worry. And it continues to go up because they continue to spend about $1 trillion a year in a budget deficit. The PE of the market doesn't seem much different. It bounced around a lot more in 2009, but it's fairly steady today. The bond yield has rallied to now about 1.8%, so there's been a strong rally from 2.8 to 1.8. Now, the interesting thing, GDP has grown by 6.6% and revenue has only grown by 1%. The interesting thing is when you look at that revenue number for top American companies and see hardly any growth, you would get quite concerned about some sort of recession. But when you look at the operating margin doubling and you see the profit doubling, you see some quite interesting things about the American economy and how it's self-healing. They are driving productivity in this last 2 or 3 years. So they've held down their cost ratios and they've opened up their operating margins, and obviously they've utilised the US dollar to their benefit. So the American economy at a corporate sector is clearly healing, okay? And if you're worried about the US stock market, you should consider two things. The bond market's rallied and the equity market, the equity corporate sector, has doubled its profits. So the fact that the American stock market has rallied is quite rational, and particularly when you've got a devaluation. So just those facts are quite compelling. Now, looking more deeply at the US economy is declining in significance. I've been through this before, if you've heard me talk about it. And that decline in significance is going to continue as Japan grows in significance. But we've got Europe stagnating, so America's hanging in there at about 22%. But it was over 30% at the beginning of the decade. It's now 22%, so we still have to wake up in the morning, unfortunately, and listen to what the Dow Jones is doing and listen to all those experts talk about it. But the US is still the biggest economy, but it's declining in significance. Now, I've posed a question very, very early on about, is the world in any worse shape than it has been, particularly after the Second World War? Now, this is interesting because the American debt of about 100 odd percent, 110% of GDP gross government debt. It was much worse after the Second World War. Interesting. So they'd been there before and they worked their way out of it. So what we're seeing, in fact, is not as bad as it was 50 years ago. And guess what? The debt in Europe and Japan was also terribly high because parts of them lost the war. So the winners had bad debt, and that also followed the Depression. But the losers had massive debt and massive repatriation repayments in terms of losing the war. So the world was a debt mess in the middle 40s. Now, if we just focus on America, it was able to pay down its debt over the next 30 odd years through two ways, I think. First of all, I think it's fair to say that that was the second half of the Industrial Revolution of America. Obviously, it was stopped by the Depression and the Second World War. A lot of developments of American corporations were created during the war as the economy mobilised, and developments of the war and the war effort were commercialised as commercial products and became part of the framework of American manufacturing. And they took products and refined products, you know, TVs and radios, God knows what else, telephones, and just kept on improving IT and came up with new products for the world. Okay, so growth healed the problem. The other thing that healed the problem was that the tax rates of America, and I think you've heard me talk about this before, the top marginal rate of tax at the end of the Second World War was 90%, and the top marginal tax rate in 1972 when Reagan, or around in the late 70s when Reagan came in, was around 70%. So two things corrected the problem: growth and a focus on growth and collecting tax from those who can pay it. What we are seeing the emergence of today, I would say, is the focus on growth again in America. America is now focused on gas and oil, the replacement of oil with this gas industry, which is now, it looks like it's going to be an export industry. So America was a massive importer of energy. It looks like in 5 years' time it'll be an exporter of energy. That is a dramatic change in the American economy. It shows what they can do when they focus, okay? Now, what's not happening is employment growth, and we'll talk about that shortly. The other thing that's not happening is they're not restructuring their tax rates. And the budget deficit is stuck there because the wealthy of America just don't want to pay tax, okay? Now, they will claim, as they do quite in a passionate way, that if you tax us, we're going to stop consuming, we're going to stop producing, and the American economy will come to a stall. Now, the problem with that argument is history, because for 40 years, America didn't stall with massively higher tax rates. So it is a completely false argument. And it'll be trotted out in the next 6 months as we go into the American election. And the question is whether Obama can withstand that debate and come up with a chart like that and say, well, history just says that's rubbish. Now, I think there is a groundswell, even at the top end of America, that they believe they have to readjust their tax rates, because unless they do, America will not close that debt gap. And here is the debt gap, and I keep on saying, is it going to be a fiscal cliff when George Bush's tax cuts run off? And it's quite incredible that he actually cut taxes for the rich, even though he couldn't even balance his budget, but that was George. The next president's going to have to address this issue. I think some of you heard me say before that the current tax rate as a percentage of GDP in America at around 15 or 16% is appallingly low. Australia's is 23, 24%. So if you think you're highly taxed, you probably are. But if you're in America, you're terribly undertaxed. It's an embarrassment. They need to lift their tax rate up to about 24, 25% of GDP, and they have to drop their expenditure down to 24, 25%, and then they'll balance their budget. And if you ask Wayne Swan, that's what he does. He just balances your budget. You just tax more and you spend less, and it's not that hard if you say it quickly. The interesting thing about America is that over 40 years, they've only balanced their budget or got a surplus 2 years. I always look at that and say, well, it's a wonderful place, America, that they just spend more than they can afford at a government level. Now, they've got this ageing population, they've got this health system they've got to fund, so they're going to have to deal with the tax issue. And I think that's 2013 in America. Now, if you think America has slowed to a walk, you're wrong. If you look at this chart, this tracks trade, import and export in America. And if you agree with me that the period from 05 to 07 was the end of an almighty debt binge in America, which probably overstated GDP, so America grew faster than it probably, and so that was probably an aberration in terms of economic history, and you sort of dismiss that. Then you look at where America is on trade account now, you could come to the conclusion that America is trading more strongly than it ever has before in terms of trade account. So both exports and imports are matching the levels of 2007. Admittedly, they're not in surplus, but the gap is closing, and it will close with gas and oil. But the actual quantum of trade of America going in and out is at the same level it was in 2007. Now, I'm a pretty simple guy, but that doesn't look like a recession to me. That looks like a quite dynamically growing economy when you look at it. The unfortunate thing is it's not generating jobs. And we've talked about this before because American corporations would rather employ people in China than in America. Industrial production is almost back to where it was in 2007. It had an almighty collapse when we had the GFC, a massive recession in America, and now it's recovering. You cannot deny that industrial production is lifting. However, again, it's being lifted through two things: massive productivity increases and without bringing labour back to America. But America's industrial production is back to 2007 levels. Okay? Remember, I say that 2007 was an aberration because it was driven by debt. You cannot deny that for 26 months America has added jobs. Now, when we all get depressed last Friday and America only got 64,000 jobs, does anyone know why we're depressed? Can anyone get up and tell me why we're depressed? Yep.
Because we expected something a bit better.
We did we? There's expectations. Who created those expectations? Who are these people? Well, the only thing I could say about the expectation guys is they were wrong. And more times than not, they are wrong. They either get it wrong on the upside or they get it wrong on the downside. How economists working for banks en masse can come to 150,000 jobs, like they all came at the same number. You know, dozens of independent economists somehow calculated that there would be 150,000 jobs created in America. Did they count them? Did they? They have no idea. So they created that expectation and we didn't get it. Now, why were they creating an expectation? I don't know. Maybe they were long the share market. Maybe they were trying to talk the share market up because that's the way they trade in America, the investment bank. So they're creating expectations in our mind, and then when those expectations aren't met, we get confused. And I just question whether we should be listening to these guys because I think they are playing games. I think in America, the American banks are trading games, are trading sentiment for their benefit in the stock market, and I think over in Europe, they're trading sentiment to try and protect themselves. And that's a very big call. And you won't read about it in the paper tomorrow. But I think I'll prove my point shortly. So the fact that employment's grown for 26 months is a fact. Okay? So the economy is recovering, but it's not recovering quick enough. Now, wages are not moving in America. This is a capacity index across labour and capital. So America is still struggling to get back to where it was in terms of capacity utilisation. It's a long way below what is overcapacity, which I would suggest is close to 90%. So it's closing in on 80%, which is still quite adequate, and it's come right off the bottom where capacity utilisation was 65%. So utilisation of labour and capital is increasing quite dramatically, okay? But it's still not at a level where labour rates are going to go up, okay? So labour rates stay low, and whilst they stay low, American corporations are encouraged to employ more people, slowly, and at some point they might replace Asian jobs with American jobs. Now that looks a fair way away based on this chart, but it is closing rapidly. Now you only get the schematic of this chart because it's, when you think about the ratio is comparing US wages, manufacturing wages, to Chinese manufacturing wages. Now the ratio was 22 times in 2005, 22 times the salary. In 2010, that ratio dropped to 10, which to me, I think that means that Chinese wages probably doubled because US wages didn't move. So the Chinese wages began to double off a very low base. By 2015, BIS Rapin will think the ratio will be 5 times. And that's a dramatic change in cost of labour over 15 years. Now they're saying that Chinese growth will be 17% in terms of wages per annum, and that might take another 10 or so years, and then quickly the Chinese wage rates are closing in on the American wage rates. American wage rates only assumed to grow by 2%. Interesting, isn't it? So at that point, or leading up to that point, American corporations are going to have to deal with the issue about cost of production. Today, it's becoming interesting. In the next 10 years, it's going to become very interesting. Now, say if the Chinese rates jumped 20% per annum, then that crossover point comes very, very quickly because it's a compounding effect. Now, we saw Obama in January talk about American corporations have to bring jobs back to America. He said it in the State of the Union address. He made it very clear that he's going to start encouraging companies through tax breaks to bring back manufacturing. Now, time will tell whether he'll follow through, okay? But there is a great opportunity at some point for America to repatriate jobs. When that happens, America's growth is secure. Now, the American corporations are saying, we'd like Americans, we'd like to employ Americans, but we just don't want to bring our money back because you might tax us. And there, that's where we sit. It comes all back to tax. Now, this is the desperate chart, so there's always bad news. The housing debacle of America, all I could come up with on this one is it can't get any worse. So that's my positive slant on this chart. It cannot possibly get any worse. We've got housing starts below, what's that say, 55 years. So it's as low as it can get. It won't get any lower. How quickly it'll recover, I don't know. It's sort of driven by the next chart, which is the foreclosures. The good news on this is that foreclosures as a percentage of loans and mortgages is coming down. Still very, very high. Given those colours, you can be mistaken for that, thinking that's Spain at present, so it probably looks the same as Spain does. So it's a debacle over there. The good news over there is the American Federal Reserve moved very quickly, and a lot of those non-performing loans or loans in arrears are actually owned by the Federal Reserve. That was the great thing that Abernethy did in 2008. He took $1.5 trillion of mortgages off the banks and put them in the Federal Reserve. 1.5 trillion. So when we talk about a housing bubble in Spain, you can fix it by moving those assets off the banks and into the central bank. Okay? It's just how you do it is the question. But the good news there, as I said, it can only get better. US savings have peaked. Now, the worldwide phenomena of consumers and households is that savings ratios went up. We all got scared together and we all lifted our savings. Some countries were doing dis-saving, parts of America were overspending, but the worldwide phenomena for households is increasing savings. Now, when that trend reverses and people spend less of their income on saving, don't save less of their income and then start spending more of their income, then it starts stimulating. Now, we've seen some bouncy numbers from retail sales in America. Last 2 months have been quite poor, but leading up to that, we had 6 months of retail sales growth. So there's a bit of action at the consumer end of the American market. The consumer is coming back. He's probably going to take a holiday for 6 months while the election runs out, and I think that's fair because he's going to get so much rubbish thrown at him, he might just sort of sit on his hands. But next year, there is a groundswell recovery in retail sales in America, and that's good for China, by the way. Okay, so that's enough about America. Our point is we think America is off the bottom. The signs are good, consistently good across a whole lot of parts of industry and the economy. The doomsayers are being wrong, but the bullish economists are also wrong. So we've got the middle ground is that America is just going to recover slowly, but it's going to have to deal with its debt in the next year or so. It's going to have to come up with a fiscal strategy to bring it under control. But the good news, it's got an external strategy in developing an oil and gas industry which looks like it's going to close the trading gap. Okay? Now, bond yields in Europe. So I've only got 2 charts on Europe because, as I said to you, I was giving myself a headache looking at them. The problem with Europe is it created a single currency and is now imploding because it doesn't have a fiscal union. But the fiscal union is coming. Okay? There's only 2 ways Europe can go. Bust up, blow up, complete mess, or it goes to a fiscal union. Okay? Now, if we got Angela Merkel in here tonight and we could understand what she's talking about because she doesn't speak English, but if we could get her in here for a little while, I'm sure she'd convince us that fiscal union is the way to go. Okay? That is the German intention. But it's not going to happen quickly because we have to jump some hurdles. Okay? Now, this chart tells you how out of control the banks of Europe were. They were out of control for 8 or 9 years. They were buying bonds in Greece as if they were German bonds. They took on incredible risk for no return. The market was completely false. Okay? You've heard me talk about this before. The culprits are the banking and the credit markets. They had no concern for risk. And if you don't have concern for risk, you're going to misprice it And you're going to lose a lot of money when risk comes into the market and it's priced properly. And that's essentially what that chart shows you. Now, we've gone through the correction we had to have in bond markets, and the bond markets are going to bring fiscal discipline on some economies because they've got to start paying interest out of their tax receipts, which are dropping. And that's the issue which affects Spain and Italy and Greece and affected Ireland, and even outside the Eurozone, it's affecting UK. So that we know all that. Okay. Now, the fiscal union will occur, I think. So if you're with me on this one, this is where we're heading, okay? Now, the Spanish bailout, which we all read about last Friday, does anyone want to get up and tell me how it's working? Well, I wish I could have a glass of water while you did it. Is anyone interested in giving me a glass of water? Does anyone want to talk about the Spanish bailout, and has anyone read anything which tells us how it's going to happen? Did we not read about the Spanish bailout?
Somebody's going to give the banks about $100 billion.
Someone is it? Okay. Yeah. Yeah.
We're not sure if they're going to give it straight to the bank or to the government to give to the bank.
All right. I think it's going to the government. Okay. 3 months of what? Insurance? Time. That's how you buy time. I think no one knows. Okay, we can only speculate, and then we have to make informed speculation. And my informed speculation is there's going to be $100 billion going to the Spanish government, and the Spanish government is then going to recapitalise the banks with capital. They're not going to lend the money to the banks. And when you look at the movement, what that means is Spain borrows $100 billion, and it invests $100 billion, and its balance sheet effect is zero, because it's borrowed 100 and bought 100 billion of assets, the assets of which are the capital bases of the Spanish banks. And that's called nationalisation of banks.
Doesn't it already own 90% of Bankia?
Of Bankia, sorry, of the...
biggest bank.
It probably does, and it's going to own the rest of them by the time this is over. Thanks for that. I've got 2 glasses of water. This is going to be a long presentation, is it? Thanks. Oh. Who? No. Okay. Now, just bear with me for a minute, okay? In 2008, the thing that Bernanke did with the Federal Reserve, and you recall this, he bought rotten assets off the banks, and he did a capital injection. And the decision was made when Lehman Brothers was going broke, and was about to be parachuted, that when we open for trade one day, all the banks of America, no one will claim that they're insolvent. Because if we can convince the market that the banks of America are not insolvent, then life goes on. The way to do that was that the Federal Reserve popped in $120 billion into every American bank. Even if you don't want it, you're going to get it. And you can read lots of stuff about this. Now, I suspect what the Spanish government's going to do, and I hope, because if they don't do this, we've got a problem. So I admit that. Okay. But I think they're going to put it in capital. They're probably going to do it in preference shares, and they're probably going to have a complete squash down of the shareholders of these banks. And that's why I think that on Monday night, where was I? I was in Melbourne. Was I awake at midnight? I think I was. Now, when they had the bailout on Sunday, I don't know if you watched it like I did, because what I do for you when I'm managing your money is I never sleep. Okay? So at midnight, the German market was rallying by about 1.5%. And I thought, this is great, I can go to bed and God, I feel good. You know, everyone's worked it out. Wake up in the morning, German market's down. Apparently, when I was asleep, the markets came to the conclusion that if they've got to put 100 billion on, Ian, it can't be that good. So the week before they wanted a bailout, and when they got it, it's no good anymore. So they all came to the conclusion about 3 a.m. that it wasn't good. Can anyone work out why they didn't think it was good? Could be. I'll buy that. Now, you got it, exactly. Someone woke up at 3 o'clock and said, hold on, guys, what if this 100 billion goes into the banks as capital and squashes down the equity value of the shareholders? Okay? And then every other bank in Europe said, if this is a success, we'll be next. Yeah? And what's next? Next is we have the governments of Germany and France owning our banks. The shareholders are diluted. Guess what? They'll come in and tell the executives, you now have a salary which is about 20% of what you're getting now. There are no more bonuses. The game is up. You are now under the control of governments. I think that's what happened at 3 a.m. But they haven't told you that yet. They've come out with every other nonsense that 100 billion is not enough.
How can you earn a bonus even if they give you 100 billion?
You can make lots of bonuses.
If they give you 100 billion and the first thing you do
Yeah, it's trade it. Exactly. Yeah, it's not going to happen. Okay, so the two-tiered process is you recapitalise the banks and then you take the rotten loans off them. The only question is whether the rotten loans go into the Spanish central bank or the European central bank. You know, in that garbage bin or that one. I think the Central Bank of Europe has a bigger garbage bin, so they can take more. Now, this come out, and there's some people saying, I read it again tonight, or heard it again tonight, that 100 billion is not enough for the Spanish banking system. Well, that is such a naive view. If it's a loan, it's not. If it's a 100 billion loan, it's not enough. But if it's 100 billion capital, it's more than enough. How do I know that? Because the American banks got 120 billion in 2008, and that was more than enough. They all paid it back in 9 months. Yep. So it's a con. Everything's a con. I think it is such, sitting here, trying to live as a fund manager through this nonsense, and I've been waiting for 3 days for the Financial Review. Anyone, is there anyone from the Financial Review here tonight? Anyone who's a journalist to write an article say, maybe this 100 billion will go in as equity. You hear it first here tonight. Not one, I can tell you, I've scanned the internet and not one of them, they're all saying it's going to be 100 billion of loans. It's not. Yeah, they've done the loans. They've done $1 trillion of loans. You couldn't give them any more money. There's no point printing any more money. What you want to do is make the banks solvent. And when they're solvent, they're under control. And when the banks are under control, you can move to stage 2, which is called fiscal union. And you start controlling. You cannot let the capital markets and the debt markets trade the way they're trading with these guys running banks and really trading off the negative and the detriment of everyone else, and trading on the basis that they're protected species by governments. If you're going to do that, they should be owned by governments. And that's where I think, and if you're scared about it, don't be. It's happened in Iceland, it's happened in Ireland, it's actually happened in the mother country, United Kingdom. They're 70% owned by governments. It doesn't hurt. It's actually good. You don't have to take your money out of the ATM, you can leave it there because it's owned by a government, not owned by these other people. Okay? So when you control the banks, you don't get nonsense in the markets. Fiscal union starts. What is fiscal? And it's going to be an almighty. I'm not saying it's easy, okay? But the Germans and the French will try to get a centralised government of Europe in some form. And the governments we have in countries will be just, you know, what do they call it, just running the local economies, regional administrators. That's what I think will happen next 5 years. It could take that long. It's painful watching it. The only thing holding it is the lack of leadership. Yep. No, there'll still be... they'd love it. He loves it. It's a problem in Germany where they want to... But they actually like it too, but they just don't want to admit it. It's like tails we win, heads we win. It's beautiful. So Germany and France end up controlling the game. France is just dragged along because they need France, but really Germany. And we have this centralised government and everyone gets a seat and Germany gets 20. So Germany has the vote. But we have a centralised taxation system of Europe. Okay? So, and centralised, and this is the beauty of what I'm thinking, because everyone has the same tax rate. Okay? And once you centralise tax rates, then you can start fixing the problem. The problem will not be solved by devaluing currencies. It helps, but it won't be solved. You will start driving business throughout Europe through taxation changes. For instance, say my theory comes to pass, and then the centralised government of Europe says, okay, corporate tax rate 35%, except in Greece, where it's 0, and Italy it's 10%, Spain it's 10%. If capital works fairly, capital moves to the low tax countries, and you get regeneration of economies. That's why a central union works. Now, we're going to have a great test on Sunday. We've got the Greeks voting. Is anyone from Greece here? Good, I can be honest. The Greece situation, I actually think it doesn't matter. It's great news if they go and bail, because we can actually see a self-destruct. You know, you heard about that thing, how do you make people comply? Particularly in China, you go and shoot someone at 6 o'clock in the morning. Well, everyone will say to Greece, if you want to bail out, go. And I reckon the mess that Greece will create for itself will scare the rest of the European market to come together. So we don't want to go through that. Okay? It's probably worse news if they stay in. Think about it. I actually think it's worse news. If Greece goes, great. We can actually focus on the real game, Spain and Italy. We don't have to put up with this nonsense of 12 million people. That's just my theory. Okay? So let's not get overly concerned about Greece, but we'll read lots on Saturday. There'll be the racing guide and the football results and the Greece election. Yeah. Okay. Sovereign debt, sorry, it's old news and current news. It's just going to get worse before we restructure it. And fiscal union allows us to restructure the debt. When it's a centralised government, guess what? It's one government that has all the debt, and we have one centralised central bank which owns the debt, and you watch it, they will restructure the debt across Europe on a pro rata contra basis. Absolutely. Now, why do I think I'm right and not mad? It's because I haven't heard anyone else come up with a solution. I promise you, I read every day the same diatribe which comes out and out and out. Is that my warning buzzer? It's only 6:45. We've got another 2 hours to go. Who did that? Hang in there. You know, where was I going with that one? What did I just say?
No other solution.
There's no one's got a solution.
What about QE and monetisation?
No, that's not a solution. That's medicine. That's medicine. We don't need to print any more money. There's enough liquidity in the world. I showed you all the interest rates. Interest rates have just collapsed. Anyone who doesn't want money can pay nothing for it. That's right. That's right. It's just a medicine. It's a placebo. Is that what it is? Placebo. Give yourself more money and you'll feel good. It doesn't make you feel good. It's only growth that'll fix the problem. Okay, there's one more chart. Sorry about this. Unemployment's still high. This is the quandary. As I said, the only way to get Europe growing again is through a fiscal union, and you start stimulating employment growth in the countries which have excessive employment. Now, the good thing about Europe is it has a very good education system in general, and it's a very well-educated workplace. Okay? And they're very mobile. All of them want to come here, but they can't. We don't want that sort of people here, but don't get me started. What will happen in Europe is they will create jobs. If they get the fiscal union, they will create jobs, and there's plenty of people highly trained to do it all throughout Europe. Okay? So you'll drop the tax rates in Greece, and there'll be a workforce ready to go. You'll drop the tax rates in Ireland, there's a workforce. There's Spain. There's plenty of educated people ready to work. Okay? And wage rates won't go up for quite a while because there's too many of them. Japan, just one chart. I just don't understand this chart. I mean, Japan at least beats America on one thing. America got 2 surpluses in 40 years, and Japan hasn't got a fiscal surplus in 45 years. They have not got a fiscal balanced budget. When you say that and you look at it, you realise how lucky we are to have Wayne Swan, because he is the guy who can balance the budget. Japan has not balanced the budget in 45 years. That's why they're debt. Now, the good news from this chart is we're all worried about debt, aren't we? Put your hand up if you're not worried about debt. Great. He hasn't got any. Okay. That chart tells you that debt does not mean extinction. Japan's got the worst debt in the world, twice as bad as America, okay? 50% worse than Greece, and it survives. There is life after debt. That's clever, isn't it? Yeah. It's not the amount of debt that's a problem, it's the cost of debt. Now, Japan survives because it only pays 1% to its self-interest. It's the cost of debt that is the problem. And so far in America and Japan and Germany, there is no cost of debt. And there's a whole lot of other countries in the world where there is no cost of debt. And so the world just works its way through. The world will not end tomorrow. The world will not end on Monday when Greece does whatever it's going to do. Just won't, I promise you. Anyone want to have a bet? Because if I win, I won't be here. Okay. On to China, on to the real world. You've seen this before. It just compares GDP per capita of China and America. It's amazing that the American per capita GDP is 10 times that of China. And we saw that earlier and we're going to see it again. I just make this comment that if the GDP of China per capita went to 50% of that of America, so around $20,000 per person at that point, China is 50% bigger than America. And when you think about it, that doesn't seem an unlikely scenario, that China's GDP per capita will be half of that of America. Why wouldn't it be at some point in the next 50 years? Doesn't seem that difficult a concept. So that's what lays ahead for us. That's good news for Australia. Here's the same chart I showed you very early on about per capita. I've just changed the numbers. The interesting thing here, I wish I could have Greece on there, because you know that country we all worry about, and we've mentioned a couple of times tonight, that disaster scenario on Sunday, their per capita GDP is $30,000 per person. 7 times bigger than China, per capita. Isn't that interesting? And that's a disastrous economy. So do you think the emergence of China is going to stall somewhere at $5,000 per capita? That it's magically going to stop? And all these guys who talk about hard landings and the end of China, and it's just a big bubble, well, that doesn't look like a bubble to me. That doesn't look like a bubble. That just looks like the start of something big. And here is how big it's getting, because in the last 20 years, I've shown you this chart, some of you this before, the urbanisation of China and India. In the 20 years, from 1990 to 2010, China moved the population of America into urbanisation. Okay? Now, it hasn't quite built all the cities of America, but it is moving along that, and we'll show you a chart shortly. And that urbanisation is likely to continue for another 20 years. Not at the same pace, but another 250, 270 million people are going to move. And they have to be housed. They have to have infrastructure to support it. And I keep on saying to people, the roads to nowhere will be going somewhere at some point. And we keep on saying that these guys are overbuilding because we have no concept. Like, we're the guys who can't even build a road from Brisbane to Sydney. So we see a road in China and we say, that's rubbish. You can't do that. You don't build roads. You don't split them. That's nonsense, isn't it? If 22 million people can't do it, how can 1.3 billion people build a road? Why would you do that? From Beijing to Shanghai. Hey? Okay. And now we've got India coming in. And India is slowing a bit recently, and we're all worried about that one. I don't know why. They've got 1.4 billion people, they think. Maybe we should get the American economists who can't pick what the Labor... get them to count the 1.4 billion. Getting excited there. But the urbanisation of India is starting. Okay, and India's economy has gone well above Australia's. It was about 6 years ago, it was the same size. Now it's about 30% bigger. They are growing and emerging, but they're only about a $2 trillion economy. It's amazing. They're a third the size of China. But they're about to move hundreds of millions of people. I talked about the development of China, the large cities. It's a bit hard to read this graph, I'm sorry, but I can see it on my screen if you can't see it on yours. It just compares, I just think the interesting thing is looking at the top 10 cities of America, so the major cities of America, 10 cities, 13% GDP, 3 cities in China, 8% of GDP. So we've got a major concentration of GDP in a few cities in China. That's going to change dramatically in the next 10 or 20 years. The next 13 or 30 odd cities are going to grow substantially, and there's going to be cities we don't know about in China. They have to be when you start looking at the populations and the GDP. So the United States is a mature type of economy, and I think China's going to head that way over the next 50 years. The same sort of thing. They'll probably have 10 cities, 13, 15% of GDP. 7 cities which don't exist today, the size of Shanghai and Beijing, will come out of nowhere or be developed from what they've got. They have to continue on this route to prosperity. The massive reserves, which we talked about earlier in the central bank, they're real. China has a trade surplus. Now, we're going to be told that's make-believe as well, because if they're making up their trade surplus, then America's making up its trade deficit. Why would America do that? Why would America pay China money it didn't need to? Doesn't make sense. It is a real reserve, and it's growing. It's about $4 trillion. This is net. It's growing dramatically, 300 or 400 billion a year. Okay. Now the question is, what are they going to do with those reserves? Are they going to recycle it? Are they going to reinvest it in China? Are they going to redeploy it around the world? We have to watch what they do. Now, one thing we've watched what they haven't done is buy American bonds for 12 months. They've stopped buying bonds. And that's one of the reasons why America had to accelerate its quantitative easing in the first half of last year. And I think the Chinese are very good to America. They told them they weren't going to buy bonds. It's terrible when you have a bond tender and no one turns up. I think that the Chinese were very nice and said, look, we're not turning up next week, you work it out. And they gave the central bank plenty of warning, and the central bank bought their own bonds. That was quantitative easing too. The good news is they haven't been there at all for a year. And the bond market, unbelievably, has traded on without China participating. It's quite amazing. Now, I don't know whether that's strange or not, but The banks of the world are quite happy to buy American bonds at 1%.
Hasn't China actually sold?
Yeah, sold down.
Yeah.
But their friends in Japan and UK have been buying bonds. Now, that's a quandary, isn't it? Where are they getting the money from? That sounds like a round robin. Credit is not loose in China. Another furphy. Okay, this is, I think I've shown you this ratio before. This is the amount of deposits which Chinese banks deposit with their central bank. We hear about massive speculation in property. We have property booms, busts. Banks are insolvent. Well, if they're insolvent and they've got 20-odd% of their money with the central bank, I just don't think so. It's a very tight credit market, and it needs to be because China is a developing economy. As you can see, you only got to go back 5 or 6 years, and you could see that the Chinese central bank could release a massive amount of liquidity back into the banking system of China, and that would propel growth if needed. Okay? So there's plenty of power in the central bank of China to release liquidity, and guess what? It's beginning to do so very slowly, because it's not going to do what everyone else does and just cut the thing and see what happens. It's going to cut it slowly and see how the economy reacts. Okay? If you think the Chinese economy is going to collapse, they will be way ahead of you and they will be stimulating very, very quickly. Plenty of power there to do that. Now, the other furphy is the iron ore and coal market, and this is an interesting chart. It tracks when economies, major economies of the world, hit a per capita production of steel of 500 kilograms per person. Why 500? I don't know. It was on the chart, and it's the only one I could get. But it's interesting that at that ratio per capita steel production, America hit that during and after the Second World War, and went and held that level for 30 years as it built the economy we see today. Japan came out of the straitjacket in the early 60s and has spent 44 years producing steel at that rate and hasn't stopped yet. Germany came out of its straitjacket and has spent 45 years producing steel at that per capita rate. South Korea kicked in as an industrial centre of Asia 27 years ago, producing steel at that rate. China hit that rate of steel production 2 years ago. Okay? Now, do you really think it's going to stop producing steel suddenly? Completely buck the trend established by every other major economy in the last 50 years, and China's just going to close down shop and stop. It's not. It's going to be a very long process. Now, it might not grow a lot, but it's going to continue to produce a lot of steel because it has to build the infrastructure. Okay? So that's a very telling chart and very good news for the resources cycle of Australia. The issue with resources in Australia is not so much the price, it's the volume. And this chart gives me a lot of confidence that volume of Australian exports of resources is going to be maintained for quite a long time. Back on Australia, and this is the good news, this is the Wayne Swan chart. This is Australia's debt is still amongst the lowest in the world. And it's not going to grow next year because we've got a balanced budget. And that's unbelievable in this world today because everyone else can't manage that, but we can. Now, time will tell, and I'm not a cynic. But on my reading of it, I think we're going to miss it by about 10 or 15 billion. But it doesn't matter because he won't be the Treasurer. The real problem is this wealth problem, and I've talked to you about it before. It's an exciting problem for a fund manager, but not too exciting for the next generation. The people in this room continue to grow their wealth, and if you project out a bit, the people over 55, it looks like they're going to own about 60% of Australia's household wealth in about 3 or 4 years' time. A massive movement of wealth on an age demographic. And the good news for you guys is you're living longer, okay? And you might think, why is that good news? The good news is the longer you live and the longer that you can maintain your brains and your outlook, as long as you can stay conversant, okay? As long as you can hold it together, the government will look after you, but not forever, okay? It's interesting. I think the government says, we've just had a look at the 18-year-olds. A lot of them don't know how to vote. A lot of them won't vote. A lot of them don't care. There's not enough of them to worry about just yet, so we'll just focus on you people in this room and we're going to protect you. Even though we shouldn't, even though zero pension schemes and all that is outrageous, you're protected for a while because your vote is important and we're not going to touch you. However, if you're 50 years old or a little bit younger, we're going to give you a hammering. Okay, we're going to take your superannuation contribution off you, even though probably 1 million people went through the gate before you and put millions of dollars into super and now living the luxury life of tax-free. But if you haven't got through the gate, we're going to give you a hard time for a few years. Don't worry, we'll get to those guys through the gate. We'll get back to them. But when they diminish a bit and they don't start and they stop voting, that's a few years. So you are a protected species, but watch what the government does and it'll give you a hint for what's going to happen in the future. So in the last budget, we've had the contribution reduced, limit, which annoys me a little bit. So guess how old I am. And they've cut out the Medicare, the health insurance rebate. They're starting to tinker at the edges. But you people were protected, so that's good news for you, okay? So just watch it. And the reason why they've got to start doing it is because we've got a problem in Australia. We've got a massive household debt. So we've got the over 55s with the wealth, the protected species, and we've got this massive lot of debt somewhere else. And it looks like it's between 30 and 45-year-olds, the young aspiring family. And the government's trying to work out how does it deal with these people. That chart tells you why a lot of people in Australia are so annoyed. You know, I know you guys are so happy. You're not paying tax. You're living in pension, pension mood. It's wonderful. You go to Europe, you go have your coffee, you go to lunch and have restaurants and play golf. It's wonderful. What is there not to be happy about? If you wanted a job, you could get one. You just don't want one because then you'd have to pay tax. So it's a wonderful period for you, but the people who have to work, who have the debt, who have the 2 kids, going to private school, have got negative mortgages, can't pay the rent, can't pay the interest, they are seriously annoyed. They're the guys who are stuffing up the economy. They're not spending. They used to spend, they used to borrow their heads off, and they spent and retail sales are good, but now they're on strike. How do we get them to start feeling happy? And the problem's there in that debt load, and it's a real problem. Now they're beginning, they're walking, they're beginning to make their own decision to reduce debt. Not to be outdone, the New South Wales State Government 2 nights ago decided, no, that's not good enough. We're going to get you to buy a house. There's 76,000 houses in the next 2 years. We're going to give you $30,000 to make you buy a house, and do not stop. So the government will come in occasionally and start assisting the next generation. But we've got this quandary. There's too much debt with one part of the economy, and there's no debt with the other side, too much wealth. And I just warn you, or in the next 10 years, there's going to be massive changes. They're going to come after us. So the more money you can build up now in your capital, the better. Because when you start paying tax again, you don't want to have not much capital. The other issue, which you should be aware of, is at the other end, when we came through the pension gate, there's another gate, and that's the exit gate. Okay. Now, just before you get to the exit gate, there's a thing called retirement and nursing homes. And you should be tracking the cost of nursing homes. If you want to go into one, it's going to cost a fortune. So you can't assume that I'm going to have $2 million at 60 and I'm going to get to zero when I'm 85. Now, you need $1 million when you're 85 to check in before you check out. Okay, so it's a household debt is the issue here. And we just show you in starkly, Australia's, we're in this great peer group, so our debt doesn't look too bad at 277% of GDP, but you can see on the household debt measure, we're the worst in the world. We even knock off United Kingdom on that one. United Kingdom beats us on every other measure. It's got 507% of GDP. I keep on coming back. If you don't short UK bonds, you're nuts, okay? Just ask your broker tomorrow, how can I short UK bonds? JGB, Japanese bonds? No, it's a controlled market. Don't worry about it. The Japanese own the Japanese bonds. UK market is openly... It's just ridiculous. Anyway, so United Kingdom looks like a mess, but Australia, if you look at that closely, 277% of GDP debt, it's not that bad. But the household debt is. Every other measure we look good on. Now the budget dilemma, which is no longer a dilemma because Wayne Swan fixed it, we now have a balanced budget. What he did is he increased tax receipts and he reduced expenditure. And he balanced the budget. The only problem with that is that there seems to be some imagination about the tax receipts. There's about $13 billion, which is resource rent tax and carbon tax. Now, if you talk to the mining companies, and I don't get to talk to them very often, so I just read what they say they're not going to pay it. So that's a bit of a problem. That's about $5 billion no one's going to pay. And then when you talk to the companies who do talk to us about carbon tax, they say, yes, they probably will pay it, but they have to be audited, and the audit won't be finished to 2014, and there'll be another government in, so do you think we'll pay it? Now it's interesting, isn't it? So we've got these two taxes which no one thinks they're going to pay. But we're going to pay more for our power in a couple of weeks' time. So we're going to be paying for it. So we're the lucky ones who are going to be paying the tax. So the company's going to pass on the tax and we're going to pay it before they pay it. And they might not never pay it. So if they get it and they don't pay it, who gets it? Yeah, shareholders, us. Anyway. Terms of trade, we get very depressed about the iron ore price and coal because we read all this stuff in the paper, but it's not that bad. The terms of trade of Australia have fallen a bit, but historically they are wonderful. Still over 140 years, we're near an all-time high. They might come back a bit, but I reiterate the issue for Australian resource companies is more about volume and more about the Aussie dollar and less about price. Price is important, but the volumes look like they're growing. I showed you the China growth profile. And just recently, Orica put an explosive plant into the Pilbara. They approved a capital investment, I think it was 400 million. And they're doing it on the basis that iron ore growth compounds at 10% for the next 5 years. Now, I don't think they're complete idiots. Yeah? So I do think iron ore is going to compound growth at 10% for the next 5 years. And I look at China and I can see why. I'm not sure what the price is, but I'm sure the volumes are going to go up. Here's this chart. We looked at America. The same thing has now happened in Australia. Yields on bonds have fallen below yields on shares. Now, we had the same sort of conundrum for a little while during the GFC when we were all panicking. When we settled down and we got more rational and the bond market went back to where it should have, equity markets went to where they should have, and now we've got this bond market rally and the risk-free rate of return of bonds has now dropped well below, in the last 3 months, the yield on shares. Now, the trick to buying shares which have yields is to make sure you buy shares that pay dividends, because the dividend is a yield. So there's a lot of shares out there which don't pay dividends, and they're more likely to ask you for money than give you money. And they're all lining up now. You know, we've had One Steel, BlueScope, Channel 10, Fairfax. You know, they're all lining up for their money. Okay, just avoid those companies. I would say to you, the yield on the Australian stock market is actually high when you take out the rubbish. Okay? Ignore the zero coupon companies and the yield on stocks is quite high. You look at the banks trading close to 7% franked, 10% pre-tax. Now you can buy an Australian share at 10% pre-tax yield or buy a 5-year bond at 2.25%. It's not a hard decision. You can give money to Wayne or give money to Westpac. How do we manage money for our clients? You've heard me say about this before, we have a concentrated approach. We focus on companies which are highly profitable. Profitable means their return on equity is high compared to what we think is standard. So 15% is a rule of thumb. Better than that, we're looking for. Okay, so 15, 20%. Most of the companies we invest in get much, much higher than that. Fundamental strength, balance sheet and cash flow. Obviously looking for strong balance sheets, low debt, and strong recurrent cash flow which is equivalent to or better than profit. Future prospects are important, and the future prospects of industries and businesses in the macro environment I talked about, we put it all together and come up with decisions on portfolios. Looking for good management, I guess you have to trust us on that one. You know, we try and meet the management of the companies we're in. Mainly the smaller middle-sized companies. The bigger companies, obviously, they won't see us. Marcus, what's his name? Marius Kloppers, he won't see me anymore because I've been quite critical. We always seek a margin of safety and discount the value. Okay? We don't want to pay what a company's worth. We want to pay less than it's worth. Okay? On the assumption that its price will rise to the value at some point in the future. We derive value by looking at its history. We look at what a company has achieved in return on equity. That's very powerful because it means that when we look forward and we look at market consensus or company statements, we can see what is reasonable. If they haven't achieved a financial performance in the past, they're unlikely to do it in the future unless something dramatic has changed. Now, it's easy to look at dramatic change in, say, resource companies, because if the price of resources goes up or the Australian dollar collapses, more likely than not, companies will be more profitable. But that's resource companies and they're cyclical. But mainstream industrials, their return on equity history is pretty much what they're going to get. Okay? The only way you can manipulate that is lie or gear the business. Most of them lie. Okay. We look at macro environment. We've done a lot of that tonight. to see where it's supportive of the equity market. And my conclusion right now is the macro environment driving down yields on bonds is supportive of the equity market. It might not feel like it is, and it might be painful to watch and read about Greece and Italy and Spain, but the markets have adjusted. What you're seeing, everyone else is seeing. You are not alone. Now, all you've got to do is not panic when everyone else panics. Okay? Now, what we do on your behalf is obviously not panic. We're just accumulating stocks slowly, and it does frustrate some people, I know, in this room, but we're just doing it slowly, and the good news is we haven't missed much. Okay? But stocks are now compelling value, and we're beginning to accelerate again. Okay? And the volatility in the market is the opportunity. When we derive value, I've been through it, it's based on those: profitability, historical performance, macro environment. Attractive company. Now, we've talked about Blackmores privately and openly. We're beginning to acquire this stock. The stock's come back in the market. We've been through this sort of analysis before. Here's a company which has been able to grow its profit substantially right through the GFC and has driven an export market into Asia. Okay, its profit's grown by 50% over the last 5 years, despite the fact that the Australian share market's gone nowhere. So, a bit like America early on, there are companies in Australia which are making more money than they've ever made before, and we don't think it's always reflected in their share price. So we're looking for these sort of companies, and particularly interested when their prices begin to fall. But it's been a great stock. On an opening equity of 43 million, it's been able to generate over 5 years 118 million of profit and pay $84 million of dividends, franked, tax paid. So on the opening equity, it's paid you 2 times the opening equity back in 5 years, tax paid. That is a compelling story if you can find them. And there's a few in the Australian market, and they're filtered through your market. Now, I'm not here to say we get everything right, but if we stick to this and we stick to these sort of companies, over time we will continue to outperform. Okay? So we're looking for companies with high return on equity. You can see they're well above 40% consistently, paying good dividends. When they retain equity, they grow with that retention of equity. And Blackmores has done all that. And Blackmores gives us a growth opportunity. There's always good and bad to companies. The good is the growth in Asia. The good is the ageing population sitting in this room. We're all going to have our vitamin C and our tablets for our sore joints and headaches and painful partners, and we're going to have all those sort of stuff. The negative is the emergence of a competitor, which is Swiss, which is coming in and spending a lot of money. But my view is Swiss will grow the market by spending a lot of money. There's room for a couple of vitamin suppliers and healthcare suppliers in this time. So we think the market's falling back because of the emergence of Swiss. We haven't held the stock for a couple of years. We're coming back into it. It's interesting, I don't know if anyone's aware, but the share market in Australia has not moved for 7 years. It's gone all over the place. It's been one hell of a ride. It's been like the Big Dipper at Luna Park. But if you draw a straight line where it is today and where it was, it's about 4,200 index. And there's Blackmores against the index, and this is just price. You can see this seriously outperformed the market by about 150%. So good companies will outperform. Now, the pullback in the share price towards $25, so it's come down quite a bit in recent weeks, gets us very interested in this stock. Okay? Quality companies. Now, the black line is the market. There is the market over the last 7 years. The other lines are Macmillan, Monadelphous, Blackmores, Oriton, ARB Corporation and Fleetwood. Now you might have thought, talking to the analysts in the market, that you cannot make money in the market. But you can, if you pick the right stocks and you're patient. You're patient on your buying and you're patient when you hold them. And one of the things I kick myself often is I'm not patient enough holding stocks, but I've got a couple of analysts around me who kick me every day and make sure we stick to it. A couple of them are here tonight, but a couple aren't, but it doesn't matter. Now, one of the things we're very happy with at Clime is that we identified Macmillan Shakespeare, and I'm happy to say it's probably the best performing stock in Australia, and today traded very close to its record high, which is amazing. It's hard to believe that a company can trade near its record high in the market we've got, which is down 40% from its high, the market, in the last 5 years. Yet Macmillan Shakespeare has gone up as you can see, by 600% against the market. Okay, now our job is to find more Macmillan Shakespeares. Now they're very hard to find. It ain't easy being a fund manager, but they do exist, okay? And you know we scan the market looking for these sort of stocks, okay? They're identified by high return on equity, good balance sheets, good prospects, good management. Sorry to use the word rubbish, and I hope I don't offend anyone's portfolio here tonight, but there's a whole lot of rubbish in the market. There's the black line, the black death line. If you can't get above that black death line over 7 years, you're pretty useless. And have a look at them. Macquarie Bank, QBE, Fairfax, Qantas, IAG, 10, Bluescape, One Steel, Toll Holdings have all underperformed the market, which has gone nowhere. So the market's gone nowhere and they've done worse. Yet these guys are all highly paid to run these companies. They're very well remunerated and they've achieved nothing. And everyone goes to the AGM and pats them on the back and has a cup of tea and we see you next year. It's hopeless. Some of those companies aren't paying dividends. Some of those companies have come back to the market 3 or 4 times and raised capital in the 7 years and continue to destroy it. Now, it seems to me to manage money, if you're doing it yourself in this room or you're doing it with us, is just find the companies which don't do that. And when you filter through return on equity, those companies have something in common. They have a terrible return on equity. And they were highly geared prior to 07, which makes us believe that they just traded off debt. Their balance sheet was full of debt and their customers were full of debt. So double gearing, they performed. It was an aberration. And they have been disasters. Yet they fill up the pages every day of the AFR. They are the stocks of interest. I'm not interested in Qantas. Not at all. It's hopeless. Fairfax, I guess AFR has to write about itself because it's Fairfax. You know, but honestly, and I wish Gina was here tonight because I keep on asking her to come to my presentation. I'd love to manage her money. I would not have bought Fairfax. I promise you. Okay? So whoever did in that company is silly. Okay. Key conclusions. So let's just wrap it up. The central bank intervention and support continues to be significant. So this is the big worldwide wrap, by the way. We just had our diatribe into Australia. There is no shortage of liquidity for banks, okay? So let's just take that off the table. The world is flush with liquidity, okay? Do not worry about it. That's why interest rates in bond markets are where they are. It's likely that some central banks will start arbitraging it. You can see a point where the Central Bank of Germany raises money at 1% and lends it to Italy at 5%. It just becomes what a bank... That seems to be a very sensible thing to do. So there's a bit of that going to happen, okay? Now this talk about having euro bonds, forget it. That's just nonsense. That is just a lazy credit market. That would be great for credit managers and banks. We don't have to think anymore. There's a euro bond. We don't have to distinguish between Italy and Greece and Germany. They did that 5 years ago and blew up. There's no need for a euro bond unless we have a fiscal union. So it won't happen before that happens. Europe is a mess. I'm pretty sure of that. But it will work its way through. There is a recession in Europe. I'm sorry to tell you, but there's been one for 5 years. Okay? There's just a rolling recession in Europe. It could go on for another 3 years. And we've lived through it, and we're still here. It doesn't mean the end. It's annoying, and it's also an opportunity. The banks will be recapitalised, and when they're recapitalised, they're probably going to be nationalised. And that's what's offending the banking. I really believe the banks of Europe are fighting a rearguard action to upset markets, and every time the governments or the central banks think about nationalising banks, they put up these disaster scenarios. Do not nationalise us. Keep on giving us money at 1%. Give us another trillion, and we promise we won't collapse. Okay? Now, someone in Europe's going to wake up, and I think it's when Tim Guyton must be going there every week or ringing them up and saying, look, we did it in 2008, it ain't hard. Just own them. Now, in America, the banks got away, because the banks are clever in America. They're also devious. So they took the $100 billion, and they couldn't wait to give it back, because they knew if they kept it, they were going to be controlled by the government. And they got rid of it quickly, any way they could. In Europe, they can't get rid of it. When the capital comes in, they will be controlled by the governments, and we'll get the process going of unification. When that happens, stability results, and we get on with the restructure of Europe. The US is benefiting from a weak currency, decisive monetary policy moves. Growth is appearing. I hope I've proven that to you tonight. It's not enough to reduce unemployment. There's a second layer of fiscal stimulation required. It's tax adjustments in America, tax reductions to get employment, tax lifts to get the tax back from the rich. That's what awaits us in America. Japan is a mess. I can't see how it can get out of its mess unless it devalues its currency dramatically. But it's caught in the bind because the Chinese are tied to America and America's printing money and is devaluing. So Japan's a quandary, and I really don't see any point in investing there. No, I don't invest there, but if you are invested there, I can't see the point. Really can't. You're going to take a hit on your currency. China is the growth engine of the world. It has massive economic levers at its disposal. I hope I've proven that to you. To ensure that growth continues on a per capita basis, it is hard to believe that China will not continue to grow for decades. There is no hard landing. There's no possibility of a hard landing. I just can't see it. Australia continues to grow, but the focus is on the resource sector. Current management of this growth and this taxing is haphazard. In fact, this taxing doesn't exist. Any emergence of structural certainty suggests... What is structural certainty? I just threw it in there. Any emergence of structural certainty at a political level suggests that the Australian share market at current levels equivalent to 2005 must be in value. Okay, think about it. Since 2005, Australia's grown by 15%. The profits of BHP, Rio and the four banks have grown by $20 billion in those 7 years. In the next 5 years, there's another 1.5 million people joining us. There's about 200 million people in Europe who want to come here now. Yeah? There is no shortage of growth opportunity for Australia. But we do have a part of the society which is highly negative in their outlook, and quite rightly so because of their gearing, and us in here, we're negative and we don't even know why. But that won't stop us going to Europe and having a good time at the Olympic Games. Our strategy is Europe remains weak for many years, ex-Germany. Germany's going to control the whole process. Euro remains weak. That stimulates Germany. There's got to be a bond market correction at some point. So if your financial advisor starts putting you into bond portfolios, or he listens to Ken Henry, I think he came wax lyrical on bonds. I don't know what you should do if you're a financial planner, but get a lunch off him quickly before you sack him. US slow recovery growth upsets election year, so US has got a bit of a problem for 6 months. The China growth continues. They've got massive active monetary stimulation coming and fiscal. Australian resources service companies are being solid. The correction in the market is now a good opportunity to start buying quality companies. Retail, focus on brands. I've said this before. Retail property looks a disaster in the next couple of years in Australia, so I'd be moving out of that. Banks solid, but it's all about yield. There's no growth in the bank sector. So every time Westpac gets towards 20 or ANZ towards 20, 7% yields appear. That looks darn attractive. The yield alone is better than our expectation from the market. So if the share price does nothing and we get a 10% pre-tax yield, that's a pretty good return. If you don't like it, go and buy a 2.5% bond. About 4,000 on the index looks to us to be very good value. But you have to focus on yield, and stock selection is crucial. And most of you know our portfolio. We publish this. Some people say we're mad. I don't know why that would be, that we publish our portfolio. We're happy to share it with you. I'm not telling you the price we're buying at. I'm not telling you the allocation, because if I did, I wouldn't have a job. But I am telling you what the stocks we like, and there's a few others around the horizon which we're looking at, which are not on that screen. The ones in red are the ones we're quite interested in the market. We've been buying recently, Blackmores and Iris. But true to our word, our portfolios don't change much over time, because we are high conviction. We believe in what we're doing, and companies which continue to perform, we're going to try and continue to hold as long as possible, as long as they're in value. The stocks which worry me a little bit are growth properties. I think we're probably going to move out of that. The yield, they've had a substantial rally in the market. You know, around 220, I think we can move into something else in the property trust area. We're just looking at something today. We're quite interested in Seymour, White and Forbes. They've had big pullbacks in the market. Both of them have cash in the balance sheet, strong outlooks, so you'll see a bit more activity there. We're holding Telstra. I think you can go all the way to $4, but the easy money is being made, so if I'm going to buy it, I want a bit of a pullback, but the yield is so substantial, and I'm happy to say we got that right against the market. Woolworths is doing fine. Reject Shops had a pullback. Having talked to the management there, I think there's a bit of trouble there. I think they're investing a lot in rolling out stores, probably too quickly. We're pulling back our buy price there, but they're in value. It's a pretty fundamental business. Some of you might have read what I wrote about Origin a few weeks ago in Eureka. We think that's compelling value at around $7, so we're picking that up. And our yield stocks have done very well. Very well. I mean, that has put us in good stead for the last 2 years. There's been a bit of pullback recently with bank bill futures, and I haven't got time, but I wrote again about that in Eureka last week, so if you can grab that article, you'll see what we're thinking there on the yield stocks. Brickworks I'm writing about tomorrow, so if you are a Eureka subscriber, read about Brickworks. I think it's quite a brilliant expose I wrote tomorrow, if I say something. I wrote something which I haven't read anywhere else, which makes it unique. And Clime Capital, of course, is the best listed investment company in the world. Now, our results are still good. I'm annoyed we've been knocked off number 1 over 1 year, but our 5-year numbers are quite excellent. The quantitative rating schematic from Morningstar suggests that we're pretty good. One in our category, top-rated fund manager 1 year, that's pretty good. I mean, we were 111, now we're 132, so I'm satisfied with that. It's been a very tough year in markets. Markets dropping over 9%, and we've managed to scramble through with around break even after costs. So I'm pretty, and from pension funds and super funds, you're getting a franking credit on top of that. So that's after cost before real pre-tax returns to owners. So that's pretty good. Now we should outperform the market because we don't have to be invested in the market. So I'm being a bit cheeky when I use the stock market as a proxy. Our proxy is to generate a positive return. That's what we've got to do to deploy your capital. So we're achieving that and doing it quite well. And there's the performance of our fund. I got a phone call today from the Fin Review. Apparently some ratings guy, Mercer's, have done a full industry review on the market, and we're number 2 in the market in the whole of Australia. So that's pretty good. I'm pretty happy with that. So there's an article being written about us. But crikey, it's been a terrible market, and we're comparing ourselves against a lot of fund managers who are in distress. So I think our strategy's worked. I think that the market is about to turn. At its darkest hours is the time to buy. And talking to some of you on the phone recently, I think the darkest hours are here amongst us. I think there's grim reapers amongst us, which from a buying perspective feels good. I think when people get really, really depressed, from a share market perspective, that's a good time to buy. So that's the presentation. It is too. And I'm happy to take questions. I've managed to do this in 1 hour, 35 minutes, which is pretty good for me. Right. Is there any questions? Yes.
If the mineral stakes seceded, and of course one doesn't live in South Australia, New South Wales, Victoria or Tasmania,
Yeah.
but South East Australia would be one of the worst economies in the world, wouldn't it?
In the world?
In the developed market, I'm not talking Greece.
It'd be a pretty poor, yeah, it'd be a pretty poor economy. Yeah.
GDP.
It'd probably be zero. There'd probably be quarters of zero growth. But we did have the flood.
Isn't that a problem where everyone lives?
Yeah, so I think there will have to be an adjustment of tax rates. We've already started the process. I'm being a bit flippant. I mean, the tax rates are being adjusted in terms of low-income earners in Australia. So we've lifted the tax-free threshold, and we've done some sort of tax on resources. So that's the start of what's going to happen for the next foreseeable future. The interesting thing is we do get a change of government. What are they going to do? Because a lot of these tax changes are in stone, you know, with the carbon tax and all of that. So I think the stimulation is coming. I think the fact that New South Wales government stimulated the building cycle in the last budget, and they actually don't have any money, is interesting. So I think that money's coming from somewhere. So there's a promise that the GST credits from Canberra is going up. So there is movement. I don't think we're getting the real story in Australia. There's too much political noise. We're not getting a sensible, consistent message from the politicians, which is frustrating. But I do think the Treasury and right around Australia are doing good stuff in their way, okay? Not perfect, but things are being done. Yep. Sorry.
You don't seem to be worried about inflation.
Yeah.
This year, next year, for how long? How long can you feel comfortable about it?
I will... my and our view at Clime is the inflation trigger will not come from internal developed countries, it will come from China. I've been consistently saying that the inflation will appear when China decouples from America, the American currency. So when China revalues, and they'll only do it when it suits them, we will get the inflation exportation out of China into the rest of the world. Now, there is inflation in China, but it's hard to believe that the Australian dollar is revalued against the Chinese yuan by 30 or 40% in the last 4 years. So the inflation which is occurring is not being exported to us because the currency is devalued. Okay? Now, that is not sustainable. At some point, the Chinese currency will revalue, and if inflation is still in China, it will come to us. Okay? But you'll get plenty of warning because they will decouple. And they won't just float the yuan, they'll increase it slowly over a period of time. So you'll be plenty of warning about the inflation issues. Okay? The other reason we won't be inflation in the Western world is we've got too much unemployment. There's significant overcapacity, so there's no cost push from labour, which has been the other issue for inflation.
So that's 1980.
Yeah. And there's no oil shock. In fact, if the Americans are right on gas and oil, there's a negative oil shock about to occur. You know, and maybe that's being reflected in the bond market as well. The bond market is seeing lower cost of energy, no labour cost push, and no decoupling of the Chinese currency, so it's low inflation. Now, I'm buying into that, but I think we know what to look for to reverse that view. I don't think it's that hard to follow. Yeah?
How long do you feel that?
Well, I feel confident for the next couple of years. I think if China is going to go into a slow growth period, and the indications are, they won't go into a hard landing, but there's no way they're going to revalue if their growth rate slows down. So I'm more confident about inflation if there is slow growth in China. Yeah? Yeah?
If I can add another one.
Yeah.
The other thing, you've looked at the macro thing worldwide,
Mm.
and you've made the European Union sound very, very easy.
Mm.
In fact, you've got all the political conflicts.
Yeah.
What's the potential for actually serious conflict? I mean, we're seeing it all over the Middle East, and you're telling me that countries like Italy and Greece and
Yeah.
Germany
Yeah.
are going to start loving each other to the extent...
No, they hate each other. No, passionately hate each other.
That's what I mean.
Yeah, but marriages work on the same basis. I mean, it's just a joke. It's a joke. My wife's not here. No, I'm not being flippant. I am. Sorry. You're absolutely right, but I just think economic reality will overpower the whole thing. The markets will overpower it. I'm very passionate. I reckon if Greece bails out on Sunday, buy the market, because when Greece goes into complete depression, everyone will say, I'm not going there. I'm going to work, because when you get 30-40% unemployment in Greece, you get the country running out of money, the government collapsing, the banks don't open up for business the next day. What do you think the rest of Europe's going to do? So I think you're right, but I think the pain of doing what shouldn't be done is too great. That's just my view. So good news if Greece bails on Sunday. Let's just watch it. It's going to be going back 2,000 years to the gladiators. We're going to see them eaten alive. It's interesting. They won't even turn up at the Eurovision Song Contest next year. They won't be part of it.
What's the benefit of quantitative easing when the world's full of capital, like loose capital already, and the money gets tied? Like, if you give it to the banks and all they do is invest it in bonds,
Yeah.
why don't they say, well, you can have the money, but you're not allowed to invest it in bonds?
Yeah, that's the second process. I think you're right. The first process was to get them liquid. The second process is take the rotten loans off them. Yeah. The third process is control the banks through recapitalisation. And then the next process is the fiscal austerity programs and growth programs.
Once the banks
This is-
are nationalised or
Yeah.
largely owned by government,
Yeah.
you'll see a trend away from...
Nonsense.
Yeah.
Yeah. And they'll go back to being real banks, acting like mutuals for the public good. You know, it's funny that the highest rated bank in the world is a mutual.
And the other thing, like, it's easy to be critical of America and the
I wasn't.
tax rates.
Oh, I was, yeah. I was, yeah.
And when you were
Yeah,
working,
yeah.
obviously. And but isn't it a worldwide trend? I mean, you look at just about every industrialised country.
Yeah.
The tax rates now are a half or the top tax rates are a half or a third of what they were 30
Yeah,
years ago.
yeah. So I think you've hit the nail on the head. They can only go one way.
Yeah.
Now, the political will, you know, and I think it also, I have this issue with financial institutions. I think the people who work for financial institutions made a lot of money and they've said, look, enough's enough. I'm going to go into public service and I'm going to make sure that enough is not enough for the next people who follow me. So there's too many of these financial guys working in central banks and government consultancy roles, and they're totally controlling the situation at present. So we're not getting the logical changes to the fiscal regime of America right now. And it seems to me there's too many of these guys who came out of the investment banks controlling the process. So that's my problem. There is an impediment. I said it very early on. I think there's an impediment to change, not only from the current banks, but from ex-bankers who've all over the place stopping the process. Okay? But I think it will happen. Because I just think the markets win eventually. Yeah? Oh, yeah. Okay. Yep. Yep. Sorry. Yep.
So what's your view on gold prices? Gold price in the next...
It's funny, I had a question today at lunchtime. Someone asked me, what's my view on gold prices and residential property in Australia? And I said, well, if you can find a residential property which is on top of a gold mine, buy it. But it was actually two questions, not one. Anyway, that was just a joke. I think gold, there's an argument to be bullish on it, which is the printing of currency, because you can't print gold. So you devalue paper money and you revalue gold. So that's what's happened. I think that's why gold has rallied. Part of it's fear factor, but a lot of it's justified by too much printing of money and money flowing into hard asset, gold, of value. That's that. The outlook is uncertain. How much longer that can go on for, I don't know. No one knows, because it is really in a trust market. I'm trusting that someone else will buy this gold off me at some future point in time. The cost of holding gold is low because you're not giving up much interest rate to hold it. If the opportunity cost was high, if equity markets were rallying, if bond yields were higher, the cost of holding gold would be higher. So the cost of holding gold is low, so people hold it. You all right? Now, the outlook problem is this. If we do have Armageddon in Europe, do you think central banks of Europe will be holding gold? I don't think so. I think they'll be liquidating it. If America pushes down the oil price by creating a new energy source and the Middle East goes into distress, do you think they'll be owning gold or buying gold? I don't think so. If India goes on a long-term growth profile which they're confident about, do you think they'll be owning gold? There's a lot of negative issues developing for gold because the people who own it only own it for a purpose to hedge against the US dollar. And they're probably being supported by other issues. But when some of these things fall away, I'm not too sure why some of the big holders will want to own it, unless China comes in and wants to buy it. And I think, communism doesn't say we want to buy gold. That's not for the greater good. So, I don't think there's a really bull case on gold unless you get really, really scared. And then don't be scared for long because you want to be out before everyone else wakes up. Sorry?
What was your answer on residential property? But more importantly, given what you said about the US, what do you think about investment in the US?
All right, well, residential property is obviously on slide. I think we did talk about this for at least the last year. So we've got a middle and top end market decline. Not dramatic, it's going to be well controlled. Probably needs to come back. We've got an affordability problem in Australia, and the affordability problem is addressed by government incentives. You don't need $30,000 grants to buy a house if you haven't got an affordability problem. So the reaction of governments tells you we have. The real pressure point is going to be in that 750 plus market. We've got a problem there. We've already seen cracks in the $2 million market in Sydney. So I think it's just a 5 or 10% decline, and hopefully that happens over a couple of years. And whether we can establish a base at that level really depends on the cost of debt staying low. If the cost of debt, if interest rates go back up, well then that cascading down might quicken. But not to a point where I'm worried about the banks. Okay? Now America, your problem there is the currency, but I actually feel a little bit more confident about America in terms of I think the pain over the US dollar is just about over. I think this talk about quantitative easing 3 is just talk. I think the government and the central bank just use it as a way of stabilising markets. I don't think they're going to print any more money at all. So I think the US dollar is probably stabilised, which takes one of the risk issues out for investing in America, which was the currency risk. So if you take that out, then if you can stock select in America and pick those growth stocks, levering off the economy, absolutely. But you want to back a fund manager over there who's in the market, I think.
You don't?
In terms of us falling?
Or
Yeah.
in the fall in the Australian market?
Yeah. Well, we've had a bit of a fall, 10%, and that's the terms of trade coming down. We've dribbled back into a deficit, which is disturbing because we had 11 months or so of surpluses and now we've had 3 months of deficits, a very poor trade account in March. Interesting to see what happens in June. Like, you'd like to see that trade account go back to surplus, otherwise the Aussie dollar could fall further. And it's not about exports, it's all about too much imports. And whilst ever we've got a government who doesn't want to tax imports on GST, we're going to have a lot of imports. It's quite strange that the government says we don't want to collect GST. I don't understand that. If they can't work out how to do it, why don't they give it to someone who can? Okay? Yeah. Yep. Last couple of questions coming up. This is the hard one. I'm sorry about this. Yep.
Regarding your optimism with China and the continual growth.
Yep.
Can you give a short explanation as to the values declining for BHP and Rio?
Yeah.
Limiting your percentage to approximately 10% in the portfolio.
Yep.
Your optimism with China.
Well, that's a static portfolio, so I expect the weightings to rise. When we make the portfolio decisions, we're not unaware. We have a view on the economy and economies, but we're not unaware of markets. Now, we don't want to be affected by market noise, but you'd be crazy to ignore market noise in terms of the buying strategy. Now, clearly, we've got a lot of negative sentiment. Now, some of it's self-induced by BHP and Rio regarding costs and threatening to pull back capital investment. Yeah, fair enough. We've also had a decline in iron ore prices. So you've got a couple of things happening, okay? Now, regarding the capital investment by BHP, fair enough. If you can't make capital work, don't invest it. So I'm on their side on that. What I'm not on their side is that we trust them to keep our money and they hoard it and don't give it to us in terms of dividends. Now, our expectation would be that BHP would lift their dividend in a quiet time, and they haven't done that. And I've listened to the MD of BHP, and I think it's rubbish. BHP is a public company. It's owned by public shareholders. One of the benefits of being public is you can go to the market to raise capital anytime you want. And you've seen a lot of companies go to the market in recent weeks who are in worse shape than BHP and have no potential for growth. BHP can quite clearly pay more dividends and pay shareholders the courtesy of coming back to us if they've got a good reason to come back to us and ask for the money back. Their whole modus operandi, to me, is wrong. Okay? However, they are what they are, and we adjust our buy prices based on that. If BHP showed any common sense on capital, it would be increasing dividends and buying back shares, because its return on equity is falling, you know, as it invests more capital. So that's why we're adjusting. So my answer to you is I think we're going to buy more BHP shares, but we'll buy a lot more BHP shares if they give us some indication of sensible capital management. I'm very confident China's growth in consumption of iron ore and coal is in place for many, many years. And small hiccups are just small hiccups. The growth profile, I can't believe that China in 20 years is not going to be much, much bigger than it is today. All those charts point to that. As investors, we've just got to be patient and just listen to what companies are telling us. Okay. I also think BHP is talking its own book. Now, two issues I know I'm getting to wind up at the back. You've got another question, haven't you? Following? No. Okay. BHP wants government assistance in Olympic Dam. So, of course, they're going to talk it down. The more they talk it down, the more they scare the South Australian government and the more assistance they get. That's a very clever corporate strategy, okay? Everyone adopts that strategy, okay? So I can see through that. But the cost of resources in this country to $200,000 paid to truck drivers. Now, if you're getting paid $15 million to run BHP, you probably think $200,000 is not much money to drive a truck. You see how they get out of control? And I think BHP's caused its own problems in costs. And I have a view on Australia's corporate sector to finish on. I just think if the leadership of this country and these companies dropped their salaries and showed a sign to the rest of the Australian community that they're serious, then their workers would come in behind them. But there's no leadership at all. In fact, all we see is the Prime Minister whining and dining these guys every 3 weeks. The next time we have a dinner, I'm going to throw the paper out. I'm sick of seeing their pictures. That's just me. That's my finishing note. Sorry. Okay.
Thanks, John. Just before everyone leaves, could you please take 2 minutes just to fill out those feedback forms if you want to get a copy of the presentation, or if you'd like to speak to one of our Clime directors, just note it down on there. And also, before you head out, I think Alistair's disappeared, but I'd just like to introduce you to some of the people at the back of the room from our Clime team. We've got Michael Kluckner, Alistair Robinson, Richard Proctor, and Lee Shanique. So if you wanted to speak to them about your existing portfolios, or if you would like to think about coming into one of our top performing portfolios, please have a discussion with them. In addition, we've also done a slightly different thing tonight. We actually have a table outside with our Clime team. So if you want to speak to them about the Clime system, and if you have any questions on that, please do so. And we also have the team from Clime Super out here tonight. So if you have any questions on self-managed super funds or superannuation in general, it'd be a really good opportunity to speak to Scott or Adam at the table there. So looking forward to talking with you outside, and please come in and join us for some food and drinks. Thank you.